Core and satellite portfolio. So what is core portfolio? It is a portfolio created to meet the long-term needs and goals of the investor. It is designed in such a way that the long-term returns of the portfolio is in broad alignment with the markets. That is, long-term returns should be in line with the markets. Let us see some of the examples. See here, we have diversified equity funds, large cap funds, mid cap funds, and then we have large cap based exchange traded funds or index funds. These two funds comes under the passive category. And in the debt funds, we have liquid funds, ultra short term funds, etc. All these funds can be considered as a part of core portfolio. In a nutshell, we can define core portfolio as a well diversified portfolio and not so risky one. So it should form the main portion of any financial plan. And we have one more portfolio, that is satellite portfolio. We will be seeing that in the next part. Satellite portfolio. Here the portfolio is created to take advantage of short-term market movements. Generally, satellite portfolio follows tactical asset allocation methodology. So what is tactical asset allocation? Here, we will choose asset class based on the probability of returns in the near future. If we feel that a particular asset class, say gold, will do better in the coming months, we will invest more in gold. If we feel that equity markets will deliver better returns in next 1 year, we will invest more in equity. So this is the idea behind tactical asset allocation. So satellite portfolio is held for the period when the conditions are suitable. So once we have made use of the opportunity, we will change the portfolio and we will move to the asset class which may deliver better returns at that particular point of time. So we will keep on changing the asset class. We will keep on changing the portfolio. See some of the examples. We have sector funds, we have thematic funds. Say for example, we feel that pharma sector fund will do better in the coming months. So we will invest more in the pharma sector fund. Suppose if we feel international funds will do better, we will invest more in international funds. So that is a thematic fund, isn't it? Similarly, see the second fund, long-term GILT funds. So long-term GILT funds will deliver better returns when the interest rates are expected to come down. Or generally, long-term bond funds will deliver better returns when the interest rates comes down. So investing in long-term GILT funds when we feel that interest rates will come down. So that is a kind of tactical asset allocation. That is, we are trying to make use of that opportunity. Similarly, investing more in gold funds when we feel that the political scenario is unstable. And we know that whenever there is a political instability, gold will deliver better return. So if we feel that there is a political instability, we will invest more in gold. So taking a call based on the likely behavior of the market or based on the current situation of the market, that is tactical asset allocation. So we will keep on changing the portfolio. In a nutshell, what we can say about satellite portfolio, it is a concentrated portfolio and it is a risky one when compared to core portfolio. That is, we invest in a particular sector or we invest in a particular fund to take advantage of the short-term market movements. So that is satellite portfolio. So how much to allocate our funds among these two portfolios? The general idea is that we should have 80% in core portfolio and 20% in satellite portfolio. However, the exact division between core and satellite portfolios will depend upon each investor's risk profile. And again, remember that the core portfolio is more or less stable or fixed one. So the general features are it should be a well diversified portfolio and it should deliver returns in line with the market over a longer period of time. So it is a well diversified more or less stable or fixed. We will not change core portfolio often. And when it comes to satellite portfolio, it is tactical or dynamic in nature. We will keep on changing the portfolio. In another sense, you can take it as a high risk portfolio and a concentrated one. So we invest more into sector funds, or we invest more into thematic funds, and we prefer high risk funds. So it can be credit risk fund, or it can be long term debt funds. So funds which carry high risk, funds which are concentrated in nature, those funds comes under satellite portfolio. And based on the situation, we change the satellite portfolio. So this is the difference between core and satellite portfolio. As an investor, we should have both core portfolio and satellite portfolio. The core portfolio will give you stability in returns, whereas satellite portfolio will give you an extra mileage. So it will give you some extra returns. So this is the idea.